Hi, I'm Alan Gassman. I'm here with my partners in crime, Marty Shinkman and Barry Flagg, and we're going to talk about a very interesting topic and a topic where there's a lot of creativity and a lot of choices. And that is, what the heck do you do now with existing life insurance policies? Is it time to add life insurance policies? Is it time to convert life insurance policies? And what do you do with irrevocable trusts that are holding life insurance policies? Do you still need them? Do you not need them anymore? That's what we're going to cover in the next hour. Barry Flagg has significant experience as a life insurance expert. In fact, if there was ever such thing as a life insurance expert, look it up in the dictionary. You'll see Barry's picture there.
But you won't see that picture because I took that picture down a long time ago. I don't know how that one got put back up.
I did not ask his wife for permission to use that picture, but there it is. So think about a situation where you have Bob and Mary, and they had a big estate tax issue back when the exemption was $5 million. So back when the exemption was $5 million, you set up an irrevocable life insurance trust for Bob, which has a life insurance policy on his life.
Alan, may I interject?
Sure.
You left out one of the facts in the case study. Bob and Mary are like most of our clients, and once they've signed their documents, they don't want to know from us until there's a horrible, urgent emergency. So they've never come back in all the years since 2010 or 11 or 12 when they set up this trust and bought the insurance to say, hey, does this plan still make sense? What do we do with it? And there are a lot of clients out there. I don't know if either of you have any estimate of how many insurance trusts or survivorship policies are out there, but it's a lot. And I think it's safe to assume that the vast, vast majority have not been reevaluated. Back to you, Alan.
That's exactly right. So there's Bob with the life insurance policy, and his children are doing fine. So should he still be worried about funding a life insurance policy and moving his wealth to an irrevocable trust that can't benefit him? Then you've got the spousal limited access trust that Bob set up for Mary and the descendants, and they did an installment sale. Is it time to unwind the installment sale? Is it time to prepay the note? Those are things that Bob and Mary are going to ask you about. Then there's Bob's revocable trust. He had it payable to a charitable lead annuity trust on the second death. If there was going to be an estate tax, there won't be an estate tax. Or if they're still charitable, are you going to talk about what else they can do for charity? Then there's qualified personal residence trusts, which, by the way, robbed them of the $500,000 exemption on sale, or their descendants are robbed of a step up on death. Then there's Mary's revocable trust. There's an islet on Mary's life that would have a policy that would pass for descendants on Mary's death. And then there's a second to die islet. So it's easy for me as a tax advisor to say, well, you don't need the islets anymore. You don't need the life insurance anymore. Well, wait a minute. We paid a lot of money for those life insurance policies, and they seem to have some solid cash values. In fact, we heard maybe we should put more into the life insurance policies for income tax purposes. But how do they help us now? Because we're not concerned with the federal estate tax anymore. But wait a minute, the federal estate tax may come back. The Democrats may take control in 2030. And then we'll wish that we hadn't taken apart the irrevocable life insurance.
But Alan, it's permanent. It's permanent.
Right. And then there's the buy-sell agreement between Bob and his brother on the plumbing business. And they've always had a low value on the plumbing business because they were told to keep it low for estate tax purposes. They were actually playing a little bit of Russian roulette. but Bob had extra life insurance on his life so that if he died and Mary was selling the plumbing business cheaper than it really was worth, she'd have that extra life insurance. Well, now they want a nice big step up when Bob dies. So maybe they're not going to use that low side appraisal technique. And what do they do with the life insurance that was being used to fund a buy sell with Bob's brother? Do they cash that in, or do they get even more life insurance now to reflect the practicalities of the economics of the situation? And could they use these ILETs to put in income producing property, to give money to charity, and to pay for their vacation home property taxes to get deductions? Can they take assets that are not now creditor protected and swap them for the life insurance policy so that they own creditor protected life insurance policies? You see, there's just a lot of movements that may be best recommended to optimize their situation. So Marty and I are going to lead discussion on what we might do between Bob and Mary and these various trusts. But before we get into that, we want Barry to talk.
Let me make a couple general comments, Alan. Whether your clients have the kitchen sink that Alan just illustrated or not, we all have lots of clients with different parts of this puzzle, if not the whole puzzle. I think what's changed, it's not that OBA, and correct me guys if I'm wrong, it's not that OBA changed the tax law on insurance, but it changed everything. Because, and to me, it's psychological more than anything. The exemption in 2026 would have been 14 something, so now it's 15. It's a little goose up. But for many clients, they've always been of the worry, oh, gee, the exemption's going down, the exemption's going down. And now we sound like Chicken Little. In fact, the exemption went up and it's been made permanent in air quotes, because I agree as Alan, we don't know what a future administration is going to do. And I think it'd be absolutely foolhardy to unwind a plan if your estate could be taxable under a $3 or $5 million exemption, all of which may happen. But what's changed, I think, is psychologically clients feel, oh, gee, this estate tax stuff doesn't matter. I've been reading questions and comments online. And of course, I ask AI so that I know I get the right information. And there are those amongst us and lots of people out there who are not estate professionals who are saying things like, gee, I can just do a simple will, meaning I do it on cheap online and not have to pay a lawyer because there's no estate tax. I'm only worth $25 million. That's really bad planning. That's really a mistake. So no, nothing in OBA changed insurance taxation specifically that I'm aware of, but the change of OBA psychologically changed everything about insurance planning for most people. And when I say most, the estimates I've seen is only 0.2 or 0.25, depending which estimate you read, families will be subject to an estate tax under the current $15 million permanent inflation adjusted regime. So we can take, and Alan said a lot of stuff that's very important. Let me just unpack the general concept that weaves a lot of it together. Before a client goes out and cancels an old ILET, there could be a half a dozen different viable planning options to consider before they do that. You can repurpose it for the current or new environment, whether it's a 1035 into long-term care, restructuring the policy. But to me, clients now are viewing the estate tax, most people, for the mere mortals amongst us that only, that handle estates under 30, 40, $50 million. And I'm sure most practitioners do, although some don't, but the vast majority of us do. We can proactively go to these clients that think there's nothing to do and talk about all the stuff Alan rattled off in like 3 minutes. There's a lot of planning that can really help them. And a lot of it's about rethinking and repurposing what we've done for them for the last 20 years. I'm done.
Good.
I was getting the look like my wife gives me when I'm talking about something, Alan, but I'll forgive you.
So Barry, before we get exhausted here, your part is the hardest part. Let's talk about your slides on the possibility of making an ignored life insurance trust into an actively managed life insurance trust, and then a little bit about the mechanics of life insurance and what goes through your mind when somebody calls you on the phone and says, well, I'm gonna fatten up this policy, or I'm gonna stop paying on this policy, or I'm gonna trade this policy for another policy. What do we need to know and think about?
Okay, so you asked, I think, 5 questions there. Let me see if I can get them all. First, you're talking about modernizing estate plans. I think one of the many things that practitioners can go back to their clients about and talk about is the modernization of their ILETs, not just the planning aspects of it, but ILETs have historically been treated as custodial accounts as a practical matter. The trustee sends out a gift notice, collects the gift, sends out a crummy notice, pays the premium. Those are all purely administrative functions, and that was about it. ILETs by law, under the Uniform Prudent Investor Act as adopted by the respective states, is a managed trust by law, but they've just never been really treated as such for a lot of practical reasons. Those practical reasons are evolving just like everything else. And managing ILET assets or life insurance trust assets, actively managing life insurance trust assets is now possible the same way it is for any other asset. And so now I've forgotten which question I'm on now that you asked, but the things to certainly consider if you are thinking about, okay, do I have a trust asset that meets fiduciary duties? Those fiduciary duties include, are costs justified relative to benefits? Are performance requirements reasonable relative to asset class benchmarks? Are risks of underperformance appropriate? So if you think about those 3 things, cost, performance, and risk, apply those 3 things to the assets in an ILET, you can manage the assets in an ILET just like you could any other asset. When costs are high, you can move it to a lower cost provider. If risks are unreasonable relative to risk tolerance, you can change the asset allocation, which may also involve a move to another provider, but nonetheless can be discussed and can be done, provided insureds can qualify. Did I answer all your questions?
And who do you go to for this advice? I mean,
well, so you need 2 things. You need somebody who is familiar with fiduciary or client's best interest principles. The state of New York enacted a best interest rule for life insurance. California tried to, but it got beaten back. The SEC has has issued Reg BI. So anybody who's a registered person certainly has familiarity with clients' best interest principles. So you need somebody who is familiar with clients' best interest principles. So cost, performance, and risk, like I talked about before. And you need somebody licensed to do the transaction, because if you have somebody who can just opine about it but can't actually move the account from a high cost provider to a lower cost provider, you've only accomplished half of the job. Does that make sense?
Sure. So you want to talk to us about how 1035 works?
So and this is actually a good segue. So the reason why you want somebody who is familiar with clients' best interest principles or who adheres to clients' best interest principles is the alternative regulatory regime to clients' best interest principles is called at least for decision support, is called the NAIC Illustrations Model Regulation. The NAIC Illustrations Model Regulation permits insurance companies to quote a low premium, giving the appearance of low costs, while they are actually charging high costs, reserving the right to come back later and ask for additional premium calls to cover those high costs without disclosing either the high costs nor the risks of them coming back or the risks of total loss due to policy lapse. So that's the NAIC Illustrations Model Regulation. So the reason why you want somebody who's got a client's best interest orientation is ultimately the performance of any policy will be a function of, are the costs justified relative to benefits? Are performance requirements reasonable relative to asset class benchmarks? And are risks appropriate to the client's risk tolerance? The graphs on the screen here are excerpts from Veralytic reports that measures the first of those three things, costs. So the graph on the left is shows the costs of an in-force policy. And you can see that the costs in the policy owner evaluation in bar number 1 on the far left are considerably higher than benchmarks. And remember, benchmarks are the average. That's the middle. Nobody wants average legal advice. Nobody wants to pay the average for a car. Nobody wants to pay the average for their insurance. They want to pay better than average. They want to pay fees and costs that are justified. The graph on the right shows a policy with lower costs, as evidenced again by the bar number 1 being so much lower than the middle bar. And this would be evidence of a 1035 exchange in the client's best interests. Final comment on this, under NAIC Illustrations Model Regulations, you could actually have an in-force policy where costs are on the right, and the proposal looks better under NAIC Illustrations Model Regulations, but the costs would actually be the costs on the left, and you could, if you don't look at the costs, you could, unbeknownst to you or your client, move an account from a low-cost provider to a high-cost provider, because that's what's allowable under NAIC Illustrations Model Regulations.
So Barry, let's mention that you operate a company called Veralytic, which does what I will call as a layman almost an AM Best report on not only not life insurance companies, but life insurance policies. So the attendees have a couple of your Veralytic reports, and it's pretty amazing when you run a Veralytic report on a policy, you learn all about how life insurance works and all about how that particular policy works. Is there a particular website or video or something that we could send out to the attendees to let them know how to learn about that?
Certainly the website is www.veralytic.com. I'm going to make the same disclaimer I made about the picture you used. My picture at the beginning of this presentation and the website are dated. The website is being updated. So don't judge a book by its cover. Get a report, and you'll appreciate the power of Veralytic, even though the website is a little bit old. We can also, Alan, I got a 5-minute video that we can circulate after in the follow-up materials, and a 1-minute video, a 1-minute conversation, role play conversation that planners can have with their clients that talk. It's kind of the lead-in for talking about actively managed life insurance trust, or AMLITs. Everybody knows what they're being charged on almost every asset on their balance sheet. Nobody knows what they're being charged inside their life insurance. If you don't know what you're being charged, you can't know if you're being overcharged. There's a big swing because nobody knows what they're being charged. There's a big swing between good and bad pricing. So one way to strike up a conversation about updating the estate planning is, do you know what you're being charged in your life insurance? Everybody's going to say no. Then you say, would you like to know? Everybody's going to say yes. And now you have the conversation going for updating the estate plan.
Right, right.
Can I ask you both a question?
Sure.
Sitting here listening to all your wisdom, something kind of popped into my head that it may be important. So I think most people that serve as trustees of ILETs are unpaid family members that are doing it as a favor for their brother-in-law, right? And I think, and don't laugh when I say this, but I think most people believe, oh, my brother-in-law is never going to sue me. Maybe. How about his kids? Right? Your nieces and nephews who are the beneficiaries of that trust you graciously decided to be a trustee for, and you've never done anything. Here's what I think might be interesting. There's a lot of survivorship ILETs out there, trusts that own survivorship insurance purchased for estate tax purposes. Now, we've had so many proposals to change the exemption back and forth for years. In 2020, 2021, we thought the exemption could have gone down to 3.5 million, even lower. And it was really possible. Right now, and I totally agree with Alan, you got to be very careful because whatever's permanent could change in another administration. But right now, as we speak today, you got a $15 million permanent exemption. Barry, do you have any idea, and I don't mean to put you on the spot, I just dawned on me, what the average survivorship insurance policy might be face value?
So we have two pretty big life insurance trust companies who specialize in life insurance trusts. I can look it up and I can report back, but I would say it's $3 million.
Right. So I think most of those survivorship policies were purchased when the estate tax exemption was much lower and the marginal estate tax rate much higher. But now, for the first time, we have a permanent 15 million inflation adjusted exemption. And I bet those projections, and I'm not going to comment on the technical stuff you said, I'm just going to believe you, but the projections and the cover letters and the letters from the lawyer, when those policies were bought years, if not decades ago, all talked about this is a way to pay your estate tax on the second death. The aggregate of both spouses' estates may be well below the 15 million for a lot of those policies. And if your 3 million is even ballpark, I would almost assure everybody that the majority, a significant number of those ILETs with survivorship policies are the estates are well below probably one exemption amount. So now all of a sudden, I've been doing the family a favor. I signed off to be a trustee. I signed a whole bunch of documents that I didn't read, and this is typical when the plan was put in place. I haven't talked to anybody as like a lawyer, an insurance consultant, anybody, wealth advisor, anybody in 15 years since this policy was put in place. If the kids get upset because the policy implodes, I think I have a worse issue than I ever did because, gee, Marty, you're the trustee. You are a fiduciary, buddy, and the estate tax is made permanent, the exemption at 15. There is no relevance to keeping this policy for the original purpose. You did nothing to invest the money and you lost it all. I think that's a real exposure for the trustees of these trusts in the current environment because all of a sudden it's permanent. And if they simply would hire somebody that's an insurance consultant to review and evaluate the policy and present them with options, they can have the beneficiaries sign off as to whatever approach they take, and they're probably going to be protected. But doing nothing is really a danger now.
I would agree. There's coincidentally this past week, I think it was this past week before, the largest life insurance trust company, which goes by that same name, the Life Insurance Trust Company, they've got more ILETs than any other entity, and they're also service providers for the wirehouses and most of the big institutions. So they've got more responsibility for more ILETs than anybody, and they've said that their stats, and I posted this on LinkedIn, so anybody who is interested about the veracity of this stat can go to my LinkedIn feed There's also a better picture of me on LinkedIn, so please go there. 50% of all trust-owned life insurance policy holdings are at risk of lapsing.
Wow.
50%. And so I think there's other risks too, but you know, if it was a joint life policy to pay estate taxes and there's no estate tax and then they lost everything, I think there's real risk there. Sure.
This is a really important message because all advisors should start communicating to the clients. Your insurance trust and policies should not be on autopilot, especially now.
So Barry, on page 57, I've got the first page of a chart that I think you and I worked on this chart for Jerry Hesch's Notre Dame Institute.
Correct.
A
long time ago.
So if Marcia and I had a second to die policy and a life insurance trust, and we didn't need the death benefit anymore, but it's worth more than the premiums we've paid. So we don't want to just cash it in, because if we cash it in, first of all, there may be a big surrender charge. Secondly, income tax would be payable. So is it possible that we could just buy that policy from the life insurance trust? If the cash value is $400,000, we give the life insurance trust $400,000 worth of assets. We get the policy in our names, and then we fatten it up, and we full pay it to the best we can, or we do a 1035 into another one. So how would that look? What would that be like? Is that feasible?
Sure. Well, you know, I'm not going to comment on the purchasing it from the trust part. That would be a tax consideration. But provided you can get it out of the trust, absolutely. Same considerations come into play though: cost, performance, and risk. Right. So in an ILET, you might have a low risk tolerance because you just, you know, you just want to make a gift and you don't want to have to mess with it. Well, low risk tolerance is low risk, which means you're either buying guarantees which have a cost, or you are allocating to stable value accounts which have a low rate of return expectation. But you move it out of the trust and you want to grow it, well, then that would be a different asset allocation. The other, so cost, performance, and risk, that would be the risk element. The cost element is, you know, if this was an investment, forget life insurance. If this was an investment and the fund you were in had high fund management fees, you wouldn't throw more money into that fund. You would move it to a low cost provider and then fully fund it. So are the costs justified? Costs can also be specific to the planning objective. In an estate planning context, your premiums are trying to be as low as possible. So premium loads are not as significant in the overall cost equation. If you're trying to max fund something, if you're trying to pump as much money into it as is allowable under IRS regs, premium loads are meaningful. And so, you know, yes, you can do it. Same exercise though. Same thing you would consider for any other asset on the client's balance sheet. Are costs appropriate to the planning objective? Are performance requirements reasonable? And are risks appropriate?
And I guess the other possibility for a lot of policies is I'll just reduce the death benefit to what will be hopefully supported by the cash value and not make any more premiums. But then there could be large surrender charges when that occurs, right?
Usually not. Well, yes, there can be. If the policy's been in place for 10 plus years, most policies don't have surrender charges after 10 plus years. Some of them do. Some of them go for 25 years. So you do have to, don't because it's an older policy from planning 15 years ago, don't just assume there's no surrender charges. But that shouldn't be as much of an issue. Insurability can be an issue. You know, if you're with a high cost provider, to move it to a low cost, you know, if you had a high interest rate mortgage, to move it to a low interest rate mortgage, you would have to qualify for the lower rate. Same thing with life insurance. If you are with a high cost provider, you will have to qualify for the lower costs. So reducing the death benefit on a high cost policy, you might not need to reduce the death benefit if you were to lower reducing the death benefit lowers the cost, but if you can lower the cost by just giving the insurance company less, then maybe you can keep more death benefit than you otherwise could.
Don't you restart the contestability 3-year period?
Two, but yes,
Two. Sorry.
contestability and suicide would restart. Yes, absolutely.
That's just an example of all the little nuances in every insurance move, which is why it's so important that if those listening are not insurance experts, and I certainly wouldn't put myself in that category, you really need to make sure you have somebody at the table to pick up on a lot of that stuff. There's a lot of little nuances.
Right. I'm just going to real quickly from left to right here. Term insurance, I'm sure everyone knows you pay a premium and you get a check. It's convertible. You should know when the convertibility deadline is. And if you're going to get rid of coverage, need it back, if the estate tax exemption goes down, you may want to terminate or reduce a permanent policy and replace it with convertible term policy for now. That might be part of somebody's situation.
May I chime in with the inverse of that?
Sure.
So if a client has a term policy and they've decided they don't want it anymore, if they are getting near the end of the term, and you got to be getting close to age 70 or so, you can sell a term insurance policy. So here's a policy, you turn it back into the insurance company, you get zero, but you can sell term insurance on the life settlement secondary market. And if you have the right profile, risk profile, or health risk profile, if you have had some changes in health, you could sell $1 million policy for $300,000, which would otherwise get zero.
So the second category is guaranteed universal life, which is somewhat similar to a term policy. The carrier said, you pay this premium your whole life, and as long as you die before 123, we're going to pay you the death benefit. It's almost like a bond. If the client doesn't need the money, you can run a spreadsheet, and this is almost like a bond. It's a guarantee from the carrier, we're going to pay you this certain rate of return based upon what year you die. Whole life is very much, in my mind, like a bond, because a whole life policy from a reputable carrier, if you'll pay these exact premiums, we'll give you this exact death benefit. So a client that may want to keep a whole life policy or a guaranteed universal life policy, that would be kind of like part of their fixed income bond portfolio, the way I view that. But then you get into universal life, which may, depending upon how it's invested, it may be equity, it may be bond. Equity index, maybe more equity than bond, variable, universal. There's all kinds of different kinds, but you can't just give a client an answer. You got to know what kind it is and where it goes. But Barry, my last product question for you is, a lot of clients are concerned about long-term care, nursing home costs. So how good are these policies? I've got a policy with a $300,000 cash value. I can swap it into a new policy that would have a $280,000 cash value. And I see that more than twice that amount might come out to me if I need it for long-term care. Apparently that qualifies it for a 1035 like kind exchange. Then I'm using that income tax benefited situation to effectively pay for my long-term care insurance. Is that for real? Is that something worth doing?
Sure. I mean, I think you and Marty both mentioned early on repurposing a trust or repurposing a policy that was purchased for estate tax financing 20 years ago. The client doesn't have an estate tax liability anymore, and they're in the age where long-term care risks are emerging. Then my understanding, and this is kind of a question because it's supposed to be a like-to-like exchange, like insured, like owner, like, right? You can exchange a one product type for another, and riders don't generally impact anything on a 1035 exchange. So I guess they're considering this just to fall into the category of riders. And so,
But the
yes, as far as
foundation, the chassis is an insurance policy
it
on
is,
most of these long-term. So
I think they let you play with it.
doesn't this seem like a huge opportunity for a lot of clients? Exactly the scenario Barry said. Somebody has an old policy, they bought to pay estate tax. Their whole estate is 10 million. They're a married couple with portability. They're never going to pay an estate tax. And they haven't really dealt with long-term care planning because a lot of people just don't want to think about it until it's too late. This could be the perfect solution.
Right.
if somebody's got 10 million, I would wonder why they wouldn't self-insure long-term care. I mean, they're not gonna eat up 10 million, but if they've got 3 million, it's
But they
all day
got
long.
this policy that's of no use
True,
as a
true,
survivorship policy. You're
true.
just
Okay.
taking the dollars and reapplying them, repurposing them for another purpose. And I also think, I'm blanking on the guy's name. One of the sage guys of long-term care, Peter Strauss, said at a conference 30 years ago, and it made so much sense. He said he described the sort of the emotional and psychological aspects of having long-term care, nothing to do with just the financial needs. But here's a way that you take something that really has no benefit particularly
Yep.
to the clients, and you've done it to something that now, well, hey, now we have this to cover long-term care.
Mm-hmm.
Yeah. So for the if you're not using Estate View, go ahead and sign up for your Lissy trial and send me an email if you want a little bit of an orientation. You can just follow pages 2 and 3 here. But for a client, for any client, we really like to run the numbers. It's not hard to run the numbers. And you could have Bob and Mary here, age 70 and 64. They're saving 250,000 a year right now. He's still working, and he brings in more than they spend, and they've got 30 million of investments, a $3 million home, and they're going to do a CLAT. So they're really not that worried about whether they need life insurance or not. But uh, right now, if they die this year, there's 6,700,000 that can go into a CLAT, not a big deal. But if they live 20 years, they're looking at an estate tax of $26 million, and they just may not realize that. They just may not see what that estate tax, and even after a bypass trust, even after annual gifting, even after using irrevocable life insurance trusts, with a modest $33 million net worth, they're still looking, after all that stuff, they're still looking at a $17 million estate tax. So they make a large gift, they do, and look, there's the portion of their assets that are going to go to estate tax. So then they say, well, okay, we'll do the CLAT. Well, you realize now $34 million has to go into the CLAT. Before the CLAT, it was a $13 million estate tax. But in order to zero out the estate tax, $34 million has to go to the CLAT. Yes, in 20 years, your kids may get 17 million. I mean, yeah, and the charity may get 17 million. But look at the percentage of your assets that are going into the CLAT. Are you sure you don't want to keep the life insurance trusts in place? And then we run the numbers again. What if the exemption goes down by half in 2020? That's what I'm doing now. And my Republican friends say, yep, this could certainly happen. We could lose control. Well, now look at the portion that would have to go into the CLAT. So keeping that life insurance in place may be the best idea, or if you're going to reduce it, maybe get convertible term in place. Barry, Marty, any thoughts on that?
Life insurance is such a flexible tool as long as you pay attention to managing it as Barry described. And I think for many clients, they're going to cancel policies without talking to any of their advisors. And that, for many of those that do it, is going to be very foolish.
Right. So now I've just got some examples. Page 42, you got the islet, and you've got Bob. He could keep making the premium payments, leave the policy as it is. He could reduce the death benefit and stop making gifts to the trust. he could loan money to the trust. And according to Jerry Hesh, you can loan money under the Internal Revenue Code at up to 5% above the applicable federal rate. So right now that could be an 8 or 9% loan, but that would be a breach of fiduciary duty right now. But you could loan money to the islet, then you get the money back if you want, and you could charge more than the applicable federal rate. You could make split dollar loans at the applicable federal rate, or use the economic benefit regime and make loans at a lower rate. Or you could just have the islet borrow money, premium financing, which probably is not going to be the optimum financial approach for most families. Marty?
Depends. Sorry, Marty, go ahead.
No, you first, Barry.
So premium financing. So if you margin your brokerage account, you increase your return in up markets, but you double your risk of loss in down markets. So I wouldn't think of premium financing as being, inherently good or bad. It just adds risk, it adds leverage, and therefore it adds risk. For the right client, I think it's perfectly fine. But costs have to be justified, because the whole idea of premium financing is you're using the spread between short and long rates to cover the costs. If costs are too high, and too few people measure costs, if costs are too high, the transaction is doomed from the start, which is a lot of the transactions Jerry has asked us to talk about.
Let me give you number 6 idea on your list, and there's probably lots more. One of the things we've done many times is clients have these old islets, and just like I said earlier, they haven't looked at them in 15 years, which is almost always a mistake. And what we've done is we've shifted the insurance from the old style islet, because many of those were old style trusts that paid the money out to the kid at age 35, which really doesn't make sense, into a more modern slat. So we already have a slat that we created when they're doing planning in the last 5 years or 10 years or whatever. And those trusts are much more robust in terms of trust protectors, rule against perpetuities, et cetera. There's 2 ways that I see to get the insurance into the slat. In most cases, it's the same family beneficiaries. You don't have a change or issue of beneficiaries. A lot of the islets were not GST exempt, but with this new high exemption for more moderate wealth clients, you just file a late gift tax return, you file a gift tax return and make a late allocation of GST. So now the old islet is GST exempt, and you decant or merge it into the new slat. In some instances, we've sold the insurance because the slat and the islet are both grantor trust to the slat, and get a note back that just gets distributed, say, to the spouse who's a beneficiary, and the spouse can use it to contribute to their slat. So the whole plan disappears. Why do I like that, and why has that been good? First of all, I've now converted a non-GST trust to GST, and for lots of moderate wealth clients, there is plenty of GST exemption, and there'll be plenty next year as well. For clients, instead of having 2 trusts per spouse, you have 1. Everybody likes simplifying, and literally almost nobody pays attention to what we tell them as advisors to do to administer the trust. So if they have half as many trusts, maybe there's a greater likelihood of administering properly. But one of the things that Alan's mentioned is the reason to reevaluate this is the client may be saying, listen, I don't really want to pay these premiums anymore. Well, if you put the insurance into a slat that's got millions, if not a 10 million or more of assets, there's plenty of cash flow to pay the premiums, whatever insurance decisions make sense for them. So you don't have to worry about premium financing, gifts, or loans. It's going to fund it from the same pot. And clients seem to like it because it's not their money. They kind of, even though they can access the slat, or if it's a hybrid DAP or SPAT, they can access it in lots of different ways. They don't kind of like look at it quite as their money. So if you're paying it out of that pot that's not quite mine, that's fine. And that seems to be a great way to address some of these problems. But use the opportunity, if you evaluate that, to bring in an insurance consultant and check out the performance of the policies. There's no benefit of moving a policy that's about to implode someplace else. It's still going to implode.
That's right. So an alternative is he buys the policy from the trust. And as I said before, I'm in life insurance. These are creditor proof if they're owned by the insured. So he has a $600,000 brokerage account. He puts it in the trust, gets back a $600,000 value life insurance policy. And then he may fatten up the life insurance policy. You know, if he never needs to borrow from it and he never needs to pledge it as collateral, he may even take it up to the modified endowment contract status, where it may function more efficiently. He may swap it for a long-term care policy. He may swap it for a private placement life insurance policy, or he may swap it into a private placement life insurance policy or a ruggedly competitive life insurance policy that he may already have. A lot of my clients would like to fully fund 529 plans for the grandchildren. Well, he could take the ILET could go ahead and fund 529 plans. If the ILET is for the benefit of descendants, then he puts 400 grand in the ILET. The ILET gives him the life insurance policy, and then the ILET owns the 529 plans. Or Marty and Jonathan and I have been giving a lot of talks about using non-grantor trusts. So he buys the policy from the ILET. The ILET becomes a non-grantor trust. It may sprinkle the income to lower bracket beneficiaries. It may pay property taxes on property that could be placed in the ILET and be able to deduct up to $40,000 of property taxes on a vacation home. Or it may spray the money to charity if the trust agreement allows it, or if the ILET invests in a partnership or an LLC that it owns 95% of, Bob owns 5%. The income from that LLC goes to charity, and Bob doesn't have to worry about whether he can deduct it, because instead he has a reduction of income. So, Marty, anything that comes to mind with all that? Did I go too slow for you?
Alan, you've never gone too slow and you've never had too few slides.
Thank you. Here's all the states that have a creditor proof, 100% of value, no ceiling for life insurance policies. On the left-hand side by population, on the right-hand side in alphabetical order. So Mary has the same opportunity. Now, one thing, Marty, a lot of people I've noticed set up life insurance trusts that are reciprocal, and they didn't know about the reciprocal trust doctrine, and they're
Nobody cared back then.
I know. So when you look at Mary's life insurance trust, if Bob's a beneficiary, you got to take an extra step, because if they're just mirror image, then they're both going to be subject to estate tax. But maybe that's good, because if they're both subject to estate tax, then on Bob's death, there's a step up. And on Mary's death, there's a step up. Now,
doesn't that taint the asset protection?
It would taint the asset protection.
One of the ways to solve that problem is you decant one of them into the slat that's very different and leave the other one as an old-fashioned ILET. But what you say is so true. 15 years ago, before 2012, nobody seemed to ever talk about the reciprocal trust doctrine. And the Grace case was, I think, dates back to biblical times. So it's been around for a while, right? But when husband and wife, spouses did ILETs, almost nobody seemed to care.
Right. By the way, if Mary has appreciated assets and her mother is still living and her mother is elderly, then maybe we could get a court to give Mary's mother a power of appointment over that ILET that would facilitate a basis step up on the mother's death. That could be another thing to talk to Mary about. And then you have the second to die policy. So again, do you continue gifting premiums to it? Do you use split dollar advances? Do you cash the policy in and borrow from the islet? There's all kinds of things that you can do.
Let me ask a question about the survivorship insurance. Barry, and I'm sorry for putting you on the spot. I just have no idea. But we talked earlier about doing a 1035 exchange for a permanent policy in an islet or a long-term care policy. And I think a lot of clients are going to love that. What happens with a survivorship policy? And Alan, I guess there's some tax issues too, depending how the trust was set up. Sometimes people do it with two grantors, so that's kind of funky in terms of whether it's really a grantor trust and as to whom and to what extent. What about, Barry, if you have a survivorship policy, can you 1035 it into a long-term care policy for one spouse or half for each spouse or something like that?
So like kind exchange, you would have to exchange it to a joint policy if they are both still alive. There are joint life policies with long-term care benefits,
Oh, interesting.
which there's fewer of them, just like there's fewer joint life policies than there are individual life policies. There's fewer of them, but I think they're interesting, so much so that this is what we use in our own family. It's a pool, and either person can use the pool. So if one person is disabled, or excuse me, needs long-term care for a long period of time, and the other one doesn't at all, the pool's bigger. Whereas if you bought two individual long-term care policies, if one person didn't need it at all, you wasted that money. And if the other person needed it, it went beyond the benefit period, they would have exhausted all their benefits. But a joint life has a bigger pool generally. And so yes, you can do a 1035 from a joint to a joint long-term care, but it's got to be a joint.
I'm glad I asked. I did not know that creature existed. And I think for a lot of the small, old survivorship policies, that $1 million or $2 million survivorship policy, that could be a phenomenal tool and a phenomenal planning technique.
Absolutely.
That was such a good idea, Marty, that Alan actually had to close his camera down, call his broker, and get signed up for that while we were on the phone.
Exactly. So then my next thought was, you've got the Cupert. Now, the Qualified Personal Residence Trust, they put their house in there 12 years ago. Everything was going great. It would have been okay, but now they'd like to get a step up in basis on death. So, or after the grantor spouse dies, when the surviving spouse sells that house, they'd like to be able to take the 250,000 exclusion, which they can't do. So, under the Cupert statute and regulations, the grantor and the grantor spouse should not be able to buy the property back from the Cupert. So the Cupert says, thou shalt not buy the property back. But Marty, what if I go to a judge and I say, Judge, that was then and this is now, and this pleasant couple who have contributed to your campaign fund would like very much for you to just rule out that language. It shouldn't have applied. It's against the public policy of our state. So the judge does that. So what does the IRS do? Do they retroactively disqualify the Cupert? Is there a gift from when the Cupert was made? And I guess the bigger question is, does anyone care?
Don't you need a ruling from the highest court in the state under Bosch? I think the case is to have it binding on the IRS.
Yes, you do.
So can't the IRS say it's not the highest court, we don't care?
Right, but what's the consequence? That I made a gift of the total value of the property in the year I formed it, but the statute is run, more than 6 years have run. But if it was $1 million property 12 years ago and I reported it as an 800 gift, and now it's another 400 of exemption, when I have 15 million of exemption, I'm not sure anyone cares. I think dismantling Cuperts is going to be a fair sport.
You got to make sure that you have all the heirs on board.
Yeah.
And some heirs tend to get finicky, but I'd be really careful with that.
Right. So
And what
now,
about the lawyer that was the trustee and now is not going to get a trustee commission? Uh-oh.
that's going to be a problem.
I'm sorry.
Then the other thing that's interesting is, everybody's been so afraid of Connolly's bad. Connolly's bad. I don't like Connolly because it makes the stock worth more in my estate.
So what?
If I die, I'll get a higher basis. I want Connolly to apply.
For 99.75% of the families, so what?
That's right. And my brother and I had a 10 million business, and we somehow were calling it an 8 million business and playing Russian roulette. And now it's a $14 million business, bud. If I die, I want 7 million. Let's call Barry and get some more life insurance in the buy sell.
Alan, let me just emphasize something you said because it's really intriguing. When the exemption's going up and down and up and down and worried about it going down and down, planning was a little different. Right now, 99.75% of families will never pay an estate tax, right? And, even if that's 50% of your clients, it's a meaningful percentage for most, not all practitioners. Planning is sort of a bit of an Alice in Wonderland perspective because everything is different when you don't have an estate tax. You're now planning for wanting basis step up. I don't think you can use, like, for example, failing to pay rent on a cuprid on the back end of a cuprid to argue for estate inclusion. I think Gridiron or something like that was the name of the case. But you can reevaluate how you handle planning, just like you said, Alan, because for many people, it's all topsy-turvy now. You just have to be careful because you don't want to cancel the insurance or get a house back in the estate. No, the Democrats sweep in a future election and the exemption is now under the new Bernie Sanders plan, $2 million.
Wait, the Bernie Sanders plan would be $200.
For the exemption.
Estate tax. I think there's also a risk that a lot of the blue states are going to increase their estate tax because their wealthy people are no longer paying the federal tax, right? Washington's already.
Yeah, I was just going to say Washington. Tell everyone the marginal rate in Washington.
30%.
30% for a state.
Right.
Wow.
Is there anyone that has any money that's going to stay in Washington?
God only knows. So remember, the life insurance trust could become a non-grantor trust, or it could become a Section 678 trust, and it could buy my son or daughter a house, and then they could write off the property taxes on their tax return, and when they sell the house, they could take the $250,000 or $500,000 exemption. So
Alan, you said very quickly, and let me hit pause and ask you a few questions about having an insurance trust that's non-grantor. Is that viable? Is the mechanism to do that having a non-adverse party approved payment of insurance premiums? Does that work? What is the mechanism?
I'm thinking it does not. I'm saying once you take the life insurance out of that.
Oh, okay.
Yeah, I think while the life insurance policy's in the trust, it's got to be a grantor trust.
I've seen some speculation otherwise, but I just didn't understand the mechanics of it.
Right. Yeah, that was that's what I was assuming. So, let me see. Barry, do you want to talk a little bit about private placement life insurance? We do have some substantial clients who have substantial wealth under private placement life, because even business income that has a K1 to a private placement life insurance policy is income tax free. And then using this aggressive but supportable position that a private placement life policy may not need to have reinsurance once you've locked in a cash value that cannot escape the policy, you really end up with a contract that enables a income tax-free arrangement while the person's dead, and then the equivalent of a step up when they die. So Is this too good to be true? And how competitive are these policies?
So just like any other life insurance policy, but maybe less so, just because it is a policy only available to accredited investors, and therefore there seems to be a little bit more scrutiny. And it is a variable policy. Variable policies, by definition, have more disclosure, and so more disclosure has the effect of creating some more awareness around costs. So the concept of private placement in the high net worth space is if you max fund a life insurance policy, and I really don't even care if it's private placement or not, but if you max fund a life insurance policy and it's a well-priced policy, the drag of the insurance costs on that policy are somewhere between 50 and 100 basis points, probably closer to 50 for the high net worth. And if you've got investments, your favorite hedge fund manager is generating, double-digit returns, but creating a lot of ordinary income because it's short-term trading or hedging or whatever, you're paying 40% on your return, which would, if it was a 10% return, 40%, you're paying 400 basis points in tax. So paying 50 basis points in insurance costs, last I checked, 50 basis points is less than 400 basis points. I mean, it's an economic no-brainer. And that applies to all max funded insurance policies. Private placement policies can have somewhat higher costs than registered products because they are more dependent upon the reinsurance market than are some registered products. So cost of insurance charges can be higher in private placement. But when you're max funding it, that does not matter a whole lot because you're really doing it for the income tax play, not the death benefit. Two things to be very, very careful of, though, is the diversification requirement and the I call it the arm's length requirement. That's not the
Independent investment advisor. You can't control your own policy.
No. So if you've got an investment or you've got a business and you want to put it in there, you can't do it. Your investment advisor has to make the decision and document that is in. And then there's the diversification requirement, and those are rather rigid. If you fail those, you don't have a private placement policy anymore.
Okay, very good. Well, our hour is up. Marty, Barry, thank you so much for guiding us here. If anyone has any questions, you've got our email addresses in the slides. Shinkman@shinkmanlaw.com, agassman@gassmanpa.com, bflagg@veralytic.com. Please send Marty and Barry the hard questions. Send me the easy ones. And Marty,
please post your hard questions to LinkedIn so everybody can get the benefit of that, and so you can see a better picture than you're looking at right now.
Marty, anything to say?
Quick, yeah. The bottom line is, OBA didn't change insurance rules, but it changed almost everything about the analysis of existing insurance plans and insurance trusts. I think we as advisors should be proactive, whether it's articles, phone calls, email blasts, whatever it is that's your approach, to let clients know there's lots of options, but they all kind of start with having the policies evaluated to see where they are economically. And then you can advise the clients of lots of different options. And I think a lot of clients will be really happy. I love this idea, these old useless survivorship policies being turned into, I didn't even know it existed. Thank you, Barry. A joint long-term care policy. I think there's gonna be a lot of happy clients if we can get to them before they let the policies implode or take action on their own and cancel them.
Very good. Well, thanks as always to everyone. We like not only your questions, but any suggestions you may have for future programs. You'll be seeing more of Barry, and you'll always be seeing plenty of Marty. It's a good thing.
Thanks, Alan.
All right.
Thanks. Good to be with you guys.
Take care, everybody.